So here I have moved on to the volume 2 chapter 1 issue of shares. Okay, so here the important journal entries are when application money is received. So the journal entry would be bank account data to share application account, and after receiving the application money, that application money has to be transferred to the share capital. So share application account data to share capital accounts, and if any excess money has been refunded, so this entry should be passed to bank account, and if any excess money is adjusted in allotment, this entry to be passed like to share allotment account. If the share application is premium, if they are issuing it in premium, you have to show this premium account. Okay, so next, allotment. When the allotment money is due, share allotment account data to share capital account. Okay, when the allotment money is received, bank account data to share allotment account. When the call money is due, share first and final call account data to share capital. And when the call money is received, bank account data to share first and final call account. These journal entries, if you see, they follow the same pattern repeatedly except for the application stage. Only for the application stage that will be slightly different. For allotment, if you see, the same pattern only. For call, they also follow the same pattern only. The next important concept is forfeiture, reissue, and capital reserve. Forfeited shares. So when the shares are forfeited, what is the journal entry and how to write the journal entry? So the first you have to debit share capital account debtor. Okay, and securities premium account debtor, it depends on the case by case. It depends upon the question. In the question, if some unpaid money is there, and in that unpaid money, if premium is also included in that unpaid money, then securities premium account data show only the premium, unpaid premium. Okay, and two shares forfeited account. In this, how much amount you have already paid should be forfeited. Okay, to share unpaid calls account, how much money you have not yet paid still now, including premium. If premium is there, including premium. So when you are showing premium here, here also you have to show including premium. When you are not showing premium here, you should not show premium here. See, the very important thing to note in forfeiture journal entry is this premium only. Without this premium, if you see this journal entry, it's very simple. Share capital account data, premium will not come. To shares forfeited, to share unpaid call. That's all. But when the premium is included, okay, when the premium is included, you just have to be very careful. So the journal entry will be like this: share capital account data, securities premium account data, to shares forfeited account, to share unpaid calls account. The securities premium account data will be shown only when there is an unpaid call money, and that unpaid call money is including premium. Okay, so whenever you show premium here, in this unpaid calls also you have to include the premium. If you don't show premium here, you cannot show the premium here also. That's all. Okay, okay. Then reissue of forfeited shares. So the reissue of forfeited shares can be either made at a discount or at a premium or at a par. Okay, so the journal entry is bank account data, shares forfeited account data to share capital account. Okay, so bank account data, shares forfeited account data to share capital account to securities premium account if the shares are reissued at a premium. Either this shares forfeited account debtor will come, or this securities premium account will come. Okay, both will not come at the same time. So shares forfeited account debtor, here it means the shares are reissued at discount. The discount value will be mentioned here. This 2 securities premium account means shares are reissued at a premium. The premium value will be mentioned here. That's all. So reissue journal entry is this. Okay, next concept is capital reserve. So the capital reserve, the journal entry for capital reserve is forfeited shares account debtor to capital reserve account. Okay. So the forfeited shares account debtor to capital reserve account. How to calculate capital reserve? Please be very careful and please listen to this video very carefully. How to calculate this capital reserve? It's very simple to calculate. See, before you have written first forfeiture journal entry, and then second you have written reissue journal entry, then only you are going to calculate this capital reserve. So first in the forfeiture journal entry you are having shares forfeited account. In the reissue journal entry also you are having shares forfeited account. See, the number of shares forfeited and the number of shares reissued. I am repeating again, the number of shares, not the rupees, not the face value. I am telling the number of shares. The number of shares forfeited, the number of shares reissued are same. When the number of shares forfeited and when the number of shares reissued are same, you can just minus this forfeited and this forfeited, find out the difference and give it to the capital reserve amount. Okay, when the number of shares forfeited and when the number of shares reissued are in same number, for example say 3000 shares forfeited and 3000 shares reissued. If they are telling like that, then you minus this share, you take this share forfeited account and this shares forfeited account, this you minus with this forfeited account, and that will be transferred to the capital reserve account. Okay, it's very simple. But when the number of shares forfeited and when the number of shares reissued are not same, for example 3000 shares forfeited but only 1500 shares have been reissued, so at that time you have to convert this share forfeited account amount to this number of shares amount. For example, see, the shares forfeited account will show the paid call money. You can forfeit only the paid call money only, no? So see, the formula for that will be amount of forfeited shares in forfeiture entry. If the number of shares reissued and number of shares forfeited are not same, the capital reserve can be computed by the following formula. I have taken the formula in a very easy manner. So amount of forfeited shares in forfeiture entry divided by number of shares forfeited into number of shares reissued. This is the very important formula. Okay, so by applying this formula you will get one amount that you treat it as this forfeiture account amount, and then you minus it with this reissue forfeited account, then you get the capital reserve. That's all. So in case of pro rata, how you have to deal with the forfeiture, reissue and capital reserve means there will be slightly some changes in this forfeited and unpaid calls when the excess application money has been paid. So that time this entry, the journal entry will be the same, but in the amount some changes will happen. So I will be discussing that in detail while doing the problems. So for now, this is the journal entry, very, very important. And I also told you the calculation part regarding the forfeiture, reissue and capital reserve. Okay. Next, there are some basic concepts that also I would like to tell you. So there are, in case of issue of shares or in case of issue of debentures, there are three types of subscription. So which will be mostly this types of subscription will be coming in issue of shares only. So they are subscription at par, under subscription and over subscription. So subscription at par means the company issues 1000 shares and the public subscribe for 1000 shares. That is subscription at par. So under subscription means the company issue 1000 shares, but the public subscribe for only 800 shares or 900 shares like that. And over subscription, when the company issues 1000 shares, but the public subscribed for 2000 shares, which is more than the issue of shares. Okay, so that is called as oversubscription. When in case of oversubscription only, the pro rata allotment will occur. So in that case of pro rata allotment, how we have to react and how we have to calculate and all, I'll be discussing more in detail while doing the problems. So that will be very useful at that time. So now we will just note the important concepts in this chapter. So for issue of shares, only this, if you are knowing, then it means you are ready for doing the problems. Okay. So, okay. Next, I'll be moving on to the issue of debentures chapter. Issue of debentures. In this chapter, there are 4 main topics. Okay. So they are debentures issued as a collateral security, purchase consideration calculation, writing of loss or discount on issue of debentures, and debentures issued at par, premium, discount, and redeemable at par, premium and discount. So these are the 4 important concepts when it comes to issue of debentures. So first concept, debentures issued as a collateral security. When debentures are issued as a collateral security, the journal entry is debenture suspense account debtor to debentures. Okay. When taking a bank loan, so bank account debtor to bank loan account. Okay. So this is the journal entry. While doing the sum, I will be discussing more in detail how it is affecting the balance sheet and how it is affecting the notes to accounts and all I will be dealing when I am moving on to the real problem. So debentures issued as a collateral security. Please note this journal entry, very important. Sometimes they may ask in 6 marks, only for 2 marks they will ask this question. So they will split like 3 parts, and for 2 marks this journal entry, 2 marks another journal entry, and another 2 marks another journal entry, or sometimes 1 mark 6 questions they may ask. So it's very important. Next, calculation of purchase consideration. So in calculation of purchase consideration, number of debentures issued is a very important part. So to calculate the number of debentures issued, you have to use the formula, the purchase consideration price divided by the issue price. Okay. So that will give you the number of debentures issued. Okay. So the journal entries of purchase consideration I will be covering during the problem solving part. But I will be telling you some hint for journal entry of purchase consideration now, which is assets account data. You debit the asset, credit the liability, and either goodwill or capital reserve you will get, and also the vendor name has to be shown in the journal entry. This way we are going to do the purchase consideration journal entry. Okay. The next important concept is writing off loss or discount on issue of debentures. See, whenever you are writing off loss or discount on issue of debentures, you have to note that first you have to write off the loss using the securities premium account only. So the journal entry is securities premium account data, statement of profit and loss account data, to discount or loss on issue of debentures. For example, the question says that loss or discount on issue of debentures is 70,000 and securities premium is 25,000. Okay, then statement of profit and loss account is 1 lakh. Like that, if the question is saying, at that time securities premium account data, from that securities premium account data 25,000, you will be writing off the loss or discount on issue of debentures first. Then for the remaining 25,000 or 75,000, 50,000, you have to take from the statement of P&L account data the remaining amount. Then you have to close the journal entry by giving the credit. That's all. Okay. Next, issue of debentures at discount, premium and par and redeemable. In this journal entry, I am going to tell you how to write the journal entry. Okay, so bank account data, you leave one line. To debentures account, here debenture are issued at premium. So to securities premium account and redeemable at premium. So to premium on redemption. See, issued premium means you say securities premium account. Redeemable at premium means you say premium on redemption account. And the difference will be shown as loss on issue of debentures account data. This loss only you have to write off. Some sums, no, they say debentures are issued at premium and redeemable at premium, and the loss or issue of the debentures has been written off using the securities premium or something like that. So this entry you have to pass. If the question says that it is written off using the securities premium like that, then you have to use this journal entry and close it. Some sums are there like that, so I am telling you. So the next is debentures issued at a discount and redeemable at premium. So bank account data, discount on issue of debentures account data, you leave one line. To debentures account, so redeemable at premium, so to premium on redemption account. The difference is loss on issue of debentures account data. In this type of sum, you have to write off both this discount and loss. So discount is 10,000, loss on issue is 10,000, means 10 plus 10, 20,000. So that discount and loss will be written off using this journal entry if the question asks you to do so. Okay. Okay. Next, debentures issued at a premium and redeemable at a discount. So here same bank account data, leave one line. To debentures account, to securities premium, loss on issue of debentures. That's all. Okay. That's all. So for this issue of debentures volume 2, that's all for the journal entries part. So volume 2 I have completed issue of shares and issue of debentures. So detailed I will work out each and every sum, how the balance sheet will come, how the journal entries are recorded, and how the amounts are calculated. Each and everything I will be doing very detailedly when I am doing the problem part. I will be going one by one. So please follow and please subscribe to my channel. Please share the video to your friends also. support us. Okay, thank you. Volume 3, Ratio Analysis. I am moving on to the Ratio Analysis chapter for now. And secondly, I will be moving on to the chapter 1. So now ratio analysis, liquidity ratios, they are expressed in proportion. Proportion means 2:1, 1:1 like that. Solvency ratios, they are also expressed in proportions, 2:1 like that. Profitability ratios, they are expressed in percentage. And activity or turnover ratios, the answer is expressed in times, 5 times, 10 times like that. Liquidity ratios. Liquidity ratios are of two types, current ratio and then the liquid ratio. Okay, current ratio. Current ratio means current ratio is equal to current assets by current liabilities. So current assets, what are all the current assets? I have mentioned 7 current assets and 4 current liabilities. This must be known for every student compulsorily. So current assets, cash in hand plus cash at bank plus short-term investments or marketable securities plus stock plus prepaid expenses plus sundry debtors plus bills receivable. Okay. These are the current assets. Current liabilities is equal to sundry creditors, bills payable, outstanding expenses and bank overdraft. These are the current liabilities. Then moving on to the liquid ratio. Liquid ratio is equal to liquid assets by previous current liabilities. So liquid assets is equal to current assets minus stock and prepaid expenses. From the current assets, if you remove the stock and prepaid expenses, it will become as liquid assets. In liquid assets, if you add stock and prepaid expenses, it will become as current assets. That's all. Liquid asset is also, liquid ratio is also known as quick ratio or acid test ratio. This one you have to know. Working capital. How to find out the working capital? Working capital means working capital is equal to current assets minus current liabilities. Suppose if you want current assets and they have given working capital, means current assets is equal to working capital plus current liabilities. Then if you want current liabilities, so current assets minus working capital. So this is the formula. Then I'm moving on to solvency ratios. Solvency ratios are of 5 types: debt equity ratio, total assets to debt ratio, proprietary ratio, debt to capital employed ratio, interest coverage ratio. Okay, so debt equity ratio formula will be debt by equity. So debt here, it means long term debt, which means long term borrowings and long term provisions. If you add long term borrowings and long term provisions, this will be the total of the debt. Equity means preference share capital, equity share capital and reserves and surplus. That will be equity. So if you divide those both totals, debt by equity, the answer will be. Then total assets to debt ratio. Total assets by debt. Total assets means all the assets, total of all the assets. So to find out total assets, you can also do this, non-current assets plus current assets. And debt means we have already told you long-term borrowings and long-term provisions. So that's the thing. Next, proprietary ratio. Proprietary ratio is equal to shareholders' funds by total tangible assets. Shareholders' funds means what? Preference share capital, equity share capital and reserves and surplus. And under the shareholders' funds, what are all the headings are coming means they are also will come. In the first chapter, they are telling share capital and money received against share warrants, reserves and surplus. These 3 things will come under shareholders' funds. So that and all will come under shareholders' funds. Total tangible, okay. So to find out another formula for shareholders' funds is total liabilities minus current liabilities minus non-current liabilities. If you do, you will get only the shareholders funds amount. And the total tangible assets. Total tangible assets is equal to all the assets except goodwill and preliminary expenses. That's the total tangible assets formula. Next, debt to capital employed ratio. Debt divided by capital employed. Here debt means long-term borrowings and long-term provisions. Capital employed means debt plus equity. So capital employed means you have to add the debt and equity, which means long-term borrowings plus long-term provisions plus equity share capital plus preference share capital plus reserves and surplus, that is capital employed. So capital employed is also done. Interest coverage ratio. Interest coverage ratio is equal to net profit before interest and tax divided by interest on long-term debt. Net profit before interest on tax divided by interest on long-term debt. Then moving on to the third head called profitability ratios. Gross profit ratio. Gross profit ratio is equal to gross profit by sales into 100. So gross profit, to find out the gross profit, sales minus cost of goods sold. Cost of goods sold, to find out the cost of goods sold, opening stock plus purchases minus closing stock. You can also do the direct expenses also, you can deduct. Net profit ratio. Here net profit after tax. I have forgot to mention that net profit after tax by sales into 100. Okay. So net profit is equal to, either you do this formula, gross profit plus non-operating expenses minus non-operating income, or now they have shown some revised formula. You can do that one, that will be very easy. That is gross profit plus incomes minus expenses minus tax. Now the revised formula they have told like gross profit plus incomes minus expenses minus tax. To remember this formula, to remember the said formula, you can just remember the trading account which you have studied in the class 11. So that will trading account and profit and loss account. So to find out the net profit, you have to remember the profit and loss account. So in the profit and loss account, credit side, you will transfer the gross profit and you will record the incomes in the credit side. So gross profit plus income. Okay. Debit side expenses. So minus expenses. Profit and loss account debit side show the expenses. So gross profit plus income minus expenses minus tax. You will get the net profit after tax by sales into 100. So simple. Next, operating profit ratio. Operating profit ratio is equal to operating profit by sales into 100. Operating profit means gross profit minus operating expenses. Operating expenses means selling expenses, distribution expenses, administration expenses, office expenses. These are all the operating expenses. Next, operating ratio or operating cost ratio. Operating ratio or operating cost ratio is equal to cost of goods sold plus operating expenses by sales into 100. So cost of goods sold I have already told, operating expenses I have already told. So now all these things we know how to compute it. So just apply that and the answer will be coming. Return on equity. Return on equity is equal to net profit by shareholders funds into 100. Return on investment. Net profit by total investment into 100. Next, moving on to turnover ratios. Inventory turnover ratio. Inventory turnover ratio is equal to cost of goods sold by average stock, average inventory. Cost of goods sold is equal to Opening stock plus purchases plus direct expenses minus closing stock, that is cost of goods sold. Average inventory is equal to opening inventory plus closing inventory by 2. Cost of goods sold, sales minus gross profit, that also cost of goods sold. Next, assets turnover ratio, net sales by total assets. Fixed assets turnover ratio, net sales means cash sales plus credit sales minus sales return. Fixed assets turnover ratio, net sales by net fixed assets. Net sales means cash sales plus credit sales minus sales return. Net fixed assets means fixed assets minus depreciation. Working capital turnover ratio. Working capital turnover ratio is equal to net sales by working capital. Working capital is equal to current assets minus current liabilities. Net sales means cash sales plus credit sales minus sales return. Trade receivables turnover ratio. Credit sales divided by average accounts receivable. Credit sales, we know only the sales which are made in credit. Average accounts receivable means opening debtors plus opening bills receivable. Closing debtors plus closing bills receivable divided by 2. If they have only given opening or only given closing, then you cannot do by 2. Okay. Trade payables turnover ratio. Credit purchases divided by average accounts payable. Average accounts payable, same way, opening creditors plus opening bills payable, closing creditors plus closing bills payable divided by 2. If they are given only opening or closing creditors like that, you cannot average it. You can just take that, add it and just put it. But if they have given opening and closing, then you can average it. Capital employed turnover ratio. Net sales divided by capital employed. Capital employed means total assets minus outside liabilities. Or you can also use that formula, debt plus equity. Net sales means total sales minus sales return. Total sales means cash sales plus credit sales minus sales return. That is net sales. So that's all for the ratio analysis part. I'm moving on to the first chapter in volume 3. Volume 3, chapter 1, financial statements of a company. In this financial statements of a company, they are divided into 2 parts. They are Schedule 3 Part A, Schedule 3 Part B. So Schedule 3 Part A of Companies Act 2013, it says about the balance sheet of the company, vertical balance sheet of the company. And Schedule 3 Part B of the Companies Act 2013 says about the profit and loss account, vertical profit and loss account of the company. That's all. So now I'm going to show you Schedule 3 Part A of the Companies Act 2013. In your book, they have given only the format, only the heads like shareholders funds, then share capital, reserves and surplus, then money received against share warrants. But I am not showing you only the heads here. I am showing you the entire items under the each head, so that this format, when you are preparing for your examinations, it will be very useful for you. Just you can see my video or take my notes and just you can revise it like that as it is, and you can go for the exam. You will get around 6 marks, 6 to 8 marks from this chapter, and you can easily score it. So first, particulars, note number, current year, previous year. This is the format, specimen. Then equity and liabilities. Roman letter 1, equity and liabilities. Under that, shareholders funds. Under shareholders funds, A, share capital. Under share capital, what are all the share capital? Authorized share capital, issued share capital, called up share capital, subscribed capital but not fully paid up, subscribed and fully paid up. Then reserves and surplus. What are all the reserves and all? Capital reserve, capital redemption reserve, securities premium, debenture redemption reserve, contingency reserve, sinking fund reserve, any other reserve, and all will be coming in reserves and surplus. Suppose for surplus and all will be coming under this head only. Okay, so the amount you can do it. Next, money received against share warrants. If there is any money received against the share warrants, you can mention it here. 2. First, we have seen shareholders funds, number 1. Number 2, share application money pending allotment. So, application money which is pending for allotment, that you can record it here. Third, non-current liabilities. Non-current liabilities will show you 4 heads. Long-term borrowings, deferred tax liabilities, other long-term liabilities, long-term provisions. These are the 4 heads in non-current liabilities. So first, long-term borrowings. Long-term borrowings will show debentures, includes long-term borrowings includes debentures, public deposits, bonds, loans from banks and other financial institutions, and other mortgage loans and other loans and advances. Next, deferred tax liabilities net. Then other long-term provisions, premium on redemption of debentures, advances from customers long-term. This is other long-term liabilities. Next, long-term provisions, encashment of employees' earned leave payable on retirement, provisions for employee benefits, and long-term provisions. Current liabilities, 4th. Under the liability, equity and liabilities part, number 4th and last head will be current liabilities. They are also showing 4 items, which is short-term borrowings, trade payables, other current liabilities, short-term provisions. Short-term borrowings, short-term loans, loans repayable on demand, bank overdraft. These are short-term borrowings. Trade payables include sundry creditors and bills payable. Other current liabilities, interest accrued and due on debentures, interest accrued not due on debentures, advances received from customers for short term, unclaimed or unpaid dividends, calls in advance, interest thereon, current maturities of long-term debts, interest accrued but not due on secured loans, income received in advance, outstanding expenses and all will be coming under other current liabilities. Short-term provisions, provision for tax, provision for expenses, and short-term provisions will be short-term provisions. So then you total it, then go for assets. Assets will be having only 2 heads, non-current assets and current assets. Under non-current assets, there will be around 5 heads. Fixed assets, which is like they will not say directly fixed assets, they will say like property, plant and equipment and intangible assets. Under that property, plant and equipment, then intangible assets, then capital work in progress, intangible assets under development. Then non-current investments. I hope you all know the fixed assets, tangible assets and intangible assets. So I am not explaining that. Non-current investments. Non-current investments, investments for a long term and shares in companies, those investments are non-current investments. Then deferred tax assets net, then long-term loans and advances. Under that, capital advances are shown. Other non-current assets, any other assets other than this. Then current assets. Current assets will be showing the same like 5 to 6 items. So current investments, which is short-term investments or marketable securities, inventories, loose tools, stores, spares, like that. Trade receivables, sundry debtors. Trade receivables include sundry debtors and bills receivable. Cash and cash equivalents, cash in hand, cash at bank or bank balances, checks or draft in hand. Short-term loans and advances. Other current assets like accrued income, prepaid insurance, advance tax. That's all for the balance sheet part. Schedule 3, Part B of Companies Act 2013 says about profit and loss account. To compute the format of profit and loss account, particulars, note number, current year, previous year. So first, revenue from operations. In revenue from operations, the sales or sale of a scrap you can record, but it depends upon business to business. Sales means for insurance companies, sales means services. They do the sale of their services, so that also will be treated as sales. So that sales, when it comes to sales, you have to see case to case, depends upon the question. Other incomes includes any other incomes apart from sales. All incomes you can record it here. So total revenue, 1 plus 2 you have to total it, this is 3. So total revenue. Next, expenses. Under expenses, cost of materials consumed, which is purchase of material, purchase of stock in trade, changes in inventories of finished goods, either increase or decrease like that, work in progress and stock in trade, and employee benefits. Employee benefit expenses means salary, wages, leave encashment, bonus to employees, gratuity paid. These are all employee benefit expenses which are benefiting the employees. Those expenses will be coming under employee benefit expenses. Then finance costs, discount or loss on issue of debentures written off, interest on debentures or loans, interest on bank overdraft, and interest on some other long-term debts and all will be coming under the finance costs. Then depreciation and amortization expenses, goodwill amortized, depreciation on fixed assets. These things are depreciation and amortization expenses. Next, other expenses, selling and marketing expenses, rent of factory or office building, audit fee, carriage outwards, carriage inwards, miscellaneous expenses, electricity expenses. All the other expenses will be coming under this other expenses. Then total the expenses and then the total revenue. This total revenue minus with this total expenses, you will get the profit before tax. 3 minus 4, that is 5. And from this you have to calculate the tax and less, you will get the profit or loss for the period. Profit after taxes, profit or loss for the period. This will be the answer. So that's all for the volume 3 part. I have not discussed here cash flow and comparative and common size. That will be discussed straightly during the problem solving part. So it's a kind of easy only. I will be discussing during the problem solving part. So everything is completed according to, so around 95% I have tried to complete the formats, formulas, journal entries and the steps, everything from volume 1 to volume 3. Thanks for the support. Thanks for watching my video. Please share the video to your friends and who are in need and support us. Please subscribe to the channel. Like the video, comment on the comment section which sum you are feeling it difficult. I'll be solving you that sum and I'll be posting the video. Please comment me on the comment section what are all the sums you are feeling it difficult. I'll be doing the sum in the video and I'll be posting it to you. Thank you.